Picture this. You're 31. You have a regular job. You make decent money. Not a lot, but decent. You open your brokerage app one morning before coffee. You bought those shares 8 months ago. You did the research. You watched the videos. You felt smart about it. The number is down 22%. Not because you picked a scam company, not because there was fraud. The CEO gave an earnings call. Analysts were expecting $2.14 per share. The company reported $2.09, 5 cents short. Your position dropped $1,400 in 4 hours. You didn't do anything wrong. You just didn't know the rules. The real rules. The ones nobody explains in the beginner investing guides. That's what this video is about. Before we go further, I know what some of you are thinking. The market always goes up long term. Just hold. Stop being dramatic. And look, that's not wrong. Over 30 years, yes, the S&P 500 has a strong track record. I'm not here to tell you the stock market is a scam. It isn't. I'm here to tell you something more specific and more uncomfortable. The market is not designed for how retail investors actually behave. There's a difference between what the market does in a spreadsheet and what happens to your money when you're a real person with emotions, rent payments, and a 5-year horizon instead of 30. The data that makes investing look good. It assumes behavior that almost no retail investor actually manages to execute. That gap. That's what we're looking at today. Here's what we're covering. First, the real cost of being a retail investor, with actual numbers most people never bother to calculate. Second, the strongest argument for index investing and exactly where it breaks down in practice. Third, the specific exceptions, the situations where retail investing actually makes sense. And at the end, a 3-question framework you can use before you put a single dollar into any position. Not theory, something you can use tonight. Let's go. Meet Daniel. He's 27. He lives in a mid-sized city. He makes $58,000 a year. He reads enough to feel informed. In 2021, he decides to start investing seriously. He puts $12,000 into individual stocks, mostly tech, a couple of ETFs, one high-conviction position in a company he believed in. By the end of 2022, his portfolio is worth $7,800. He lost $4,200. That's 35% of his capital. Now, here's where most people stop the story. Market went down. Bad luck. Try again. But let's keep counting. Daniel checked his app an average of 11 times per day during the downturn. That's documented behavior. Robinhood published engagement data showing average session frequency spikes during volatility. 11 times a day. He wasn't managing his portfolio. He was torturing himself. He sold his biggest position in November 2022, near the bottom, because he couldn't take it anymore. That position recovered 61% over the next 14 months. He wasn't in it. His actual realized loss wasn't $4,200. It was closer to $6,900 when you include the recovery he missed. Now, add the time cost. Conservative estimate: 3 hours a week researching, tracking, reading earnings reports. Over 18 months, that's 234 hours. If his time is worth $25 an hour, and it is, because that's roughly his hourly rate at work, he spent $5,850 of time to lose $6,900 of money. Total cost of Daniel's investing journey in 18 months, $12,750. He thinks he lost $4,200. The real number is $12,750. This is not a story about a stupid person. Daniel is smart. Daniel is exactly the kind of person the investing content industry targets. Engaged, motivated, willing to put in work. The problem isn't intelligence. The problem is structural. Retail investors face costs that institutional investors don't. Institutions have risk management desks. They have liquidity. They have hedging strategies. They have time horizons measured in decades, not months, because it's not their personal money on the line. You have an app, and rent due on the 1st. When volatility hits, you feel it in your chest. A fund manager at Vanguard does not. That asymmetry is not a bug, it's the architecture. Now let me give you the strongest version of the counter-argument, because it's a good one. Stop picking stocks, buy a low-cost index fund, hold for 20 years. The data is overwhelming. This is correct, technically, historically, on paper. The SPIVA report, Standard & Poor's data, shows that over a 20-year period, roughly 90% of actively managed funds underperform the S&P 500 index. If professionals with entire teams and billions in resources can't beat the market consistently, you definitely can't. Buy the index. Hold it. Don't touch it. The math works. Here's what that argument assumes. It assumes you will not sell during a 40% drawdown. 2008, 2020. Moments when the news is screaming that the financial system is collapsing. It assumes you will keep buying on the way down. It assumes your investment horizon is genuinely 20 years, meaning you will not need that money for a house, a medical emergency, a job loss, a divorce, anything. It assumes your behavior will be rational in conditions specifically designed to trigger irrational behavior. Dalbar is a financial research firm. They've been tracking this for 30 years. Their annual report consistently shows the same result. The S&P 500 averaged roughly 9.8% annually over the past 20 years. The average equity fund investor, 6.1% annually. Same market, same index, different behavior. The gap is 3.7 percentage points per year. On $50,000 over 20 years, that's the difference between $306,000 and $176,000. $130,000 lost. Not to fees, not to bad picks, to buying high and selling low because you're a human being responding to fear and greed the way human beings do. The index fund argument is theoretically correct and behaviorally optimistic. It describes what you should do. It doesn't account for what you will do at 2 a.m. in February 2020 when your portfolio is down 34% and Twitter is saying the economy is finished. I promise to be honest. Here's the honest part. There are real scenarios where retail investing is a smart move. If you have an emergency fund covering 6 months of expenses, fully funded, in cash, not invested, then the money you put into index funds is genuinely long-term money. You are not going to need it in a crisis. That changes everything. You can actually hold. If your employer offers a 401k with any matching contribution, that match is an immediate 50% or 100% return on your money before the market does anything. Not participating in that is leaving guaranteed money behind. That is not a debatable situation. If you're in your 20s, putting a fixed amount into a diversified index fund automatically every month, not checking it, not trading it, treating it like a utility bill, the historical data genuinely supports that approach over 30 years. The math is on your side if your behavior holds. The problem isn't the instrument. The problem is using the instrument under the wrong conditions. Most people who invest in the stock market do not have a 6-month cash reserve, do not have a genuine 20-year horizon, do invest emotionally, do check their portfolios constantly. Those people aren't building wealth. They're paying tuition to the market. Let me show you how this actually unfolds. Real sequence, real decisions, each one completely reasonable at the time. Age 24, gets first real job, feels financially responsible, opens brokerage account with $3,000, buys into 3 companies he knows personally, makes sense, start somewhere. Age 25, market is up, Portfolio is up 18%. Adds another $4,000. Reads more content. Starts feeling like he understands things. Completely reasonable. Age 26. A friend mentions a stock. He researches it. Puts in $2,500. It's not a crazy bet. He has reasons. Age 27. Market corrects. His portfolio drops 29%. He doesn't sell. He's read enough to know he shouldn't. He holds. He checks the app 15 times a day. He doesn't sleep well. He tells himself he's being disciplined. Age 27, 4 months later. He needs $4,000 for a car repair and a move. He liquidates a position. It's down. He takes the loss. He had no choice. He never had a cash reserve. Age 28. He's essentially back to zero on net invested capital. He has spent 3 years, hundreds of hours, and real emotional bandwidth. Not because he was foolish, because the conditions were never right. He needed a liquidity buffer before he invested. He needed automatic contributions instead of active decisions. He needed a 25-year horizon instead of a 4-year one. None of those things were explained to him when he opened the app. Before you put any money into the market, any amount, ask yourself 3 questions. Question 1. Most people think, do I believe this stock or fund will go up? The right question. If this position drops 40% tomorrow, do I have the cash reserves and emotional capacity to hold for 3 more years without touching it? If the answer is not a clear yes, you are not ready to invest that money. You are ready to lose it. Question 2. Most people think, how much can I make? The right question. What is my actual time horizon, and is this money completely separated from any expense I might face in that period? Investment advice assumes your money is truly long-term. If there's any scenario where you might need it, medical, housing, job loss, it isn't long-term money. It's deferred spending. Question 3. Most people think, am I picking the right thing? The right question. Am I solving a behavior problem or an allocation problem? Most retail investors don't have an allocation problem. They have a behavior problem. The solution to a behavior problem is automation, not better stock picks. Automatic monthly contributions to a boring index fund, set and never touched, beats active management for most people. Not because of the math, but because it removes the decision from the equation. 3 questions. That's it. If you can answer all 3 clearly and honestly, invest. If you can't, build the foundation first. Here's what we covered. The cost of retail investing is almost always higher than the visible number. Time, missed recoveries, and behavioral errors add up to losses most people never calculate. The index fund argument is correct in theory and broken in practice for anyone without a genuine long-term horizon and a full cash reserve underneath. And the fix is not smarter picks, it's better conditions. Build the floor before you build the portfolio. If this reframed anything for you, share it with one person who's about to open a brokerage account thinking it's simple. That's worth more than a like. But the like helps too.